It's really important that your investment style is a true reflection of who you are as a person, of your personality, because there are many different ways to invest. My way is, or my team's way, is not necessarily appropriate for everybody else. I'm a bit of a worrywart. I'm a lot of a worrywart, actually. I like to build a solid foundation and make sure everything's rock solid. And then, okay, I'll take a step on it. Okay, that worked out. Let's put some more, bricks in there. And rather than just sort of running full speed ahead and hoping everything's going to be fine. And when you do that, you can give up some of the upside. But the benefit is when this happens, you don't fall nearly as much. And then you put the two together and you can end up further ahead with a smoother ride.
Welcome to another episode of Tools, Talents, and Techniques. And today I have a very special guest. Actually, I'm going to let you introduce yourself and just briefly, just give you a quick thumbnail on who you are and what it is that you do.
Yeah. Okay. Thanks, Dustin. It's great to be here. Yeah, I was a professional investor for my career, 30 years. And then recently I left my company, which I love my company and my job, but my great passion became writing and communication and empowering people. My clients were financial advisors, so financial planners and stockbrokers. And for years, I've been writing to them and doing presentations explaining what was wrong with the monetary system, why it seems to be so unfair, and why some seem to be benefiting so much more than others. And it's hard for people to connect the dots. And so I just really enjoyed making it simple for people to understand. I don't use complex terminology. I use lots of analogies. And so, if you can help people in their understanding, you can empower them. And then these very smart people can then make a big difference in the world because now they can speak the language of the economy. And so I started my own blog in 2022. It's called Political Economy. It's a play on words on political. So PAUL, political economy. And it's a free blog. It's on my website, which is Paddington Capital MGM. And then I also wrote a book, which I started 6 years ago. And it's called Capital Offense, Why Some Benefit at Your Expense. So again, just step by step, chapter by chapter, explaining how we got to this situation of exploding debt, exploding wealth disparity, exploding divisiveness within society. And so that's my thing now. I write and I communicate, and and I'm loving it.
So thanks for giving that snapshot. Let's go back to your origin story in the beginning, because working in finance. So what was the early days? What were the early days of Paul like? Were you a proficient at math or math whiz? Like, did you know that you wanted to go into investment early on?
No, I took a long path through university. I grew up in Montreal. I was born in Wales in the UK, but I grew up in Montreal. And when I was in university, I had no idea what I wanted to do. So I was just taking different stuff. All I wanted to do was read philosophy, geography, history, just like real passion for knowledge. And I had no real ambition in terms of getting a job or anything like that. I knew I was going to work. I just didn't know what. And then one day it hit me. I was taking an investment research course. And I'm proficient at math, but I'm not a math genius, that's for sure. And I like math. I do. And it just hit me. Wow. Analyzing businesses for a living would be so much fun because it involves so many things. Yes, math, accounting, and you might have to do some forensic accounting and figure out what's going on with the numbers, reading between the lines. And I did a lot of that in my investment career. There's psychology involved. Can I believe what management is telling me or not? Or why are they making large acquisitions at this point in time, or large disposals, or what's going on with these write-offs? You need a bit of history as well, geography. It just brought together so many things. And so I was about 25 25 or 26 when I realized that that's what I wanted to do. But it took me probably 7 years before I got in the industry. But I just kept moving. I was very naive, ignorant about how the industry was even structured because I was doing other stuff. And yeah, my first job, I moved to Toronto just to look for work. And I was sleeping on a hardwood floor of a bachelor apartment, like a one-room studio. And I was working at nights in a video store. And I was 29 years old. That's how I got my start. And then just, here, blah, blah, blah. Meet people or do a good job. Don't piss people off. Be dependable, you know?
There you go. Those are some keys to the journey. When did you start to realize or see that things were broken? Was it when you were doing the work and you're looking for patterns and doing the work? When did this, what you're writing about and blogging about now, when did it first come to your attention that like something's off here?
Yeah, it's a good question. In my early years, when I was an investor, I didn't see it. And so I'm talking like late 90s and early 2000s. And it was in the run up to the housing crisis. So around 2005, 2006, that's when I started noticing. Because just maybe a step back as a professional investor, our investment style is to look for high quality companies that are going to put capital to the best productive use. So as an investor, we would be taking our clients' hard-earned capital. They're giving it to us to help maybe augment their future financial security, to help them be a little bit better off. They've done all the heavy lifting. We're just trying to help that a little bit by growing their assets a little bit above inflation. And it's a very important job. And if we get it right, we allocate our clients' capital to great businesses. The great businesses put it to use. Productive capital increases in the world. The company's profitability goes up. They hire more employees. They pay them more. The share price goes up. Stock markets go up. Our fund goes up. Our clients are better off. I get paid. The advisor gets paid. And none of this comes at the expense of anybody else, right? That's how the system is supposed to work. And we can get into it later. Increasingly, it's becoming a benefit at the expense of somebody else. And so that's when I first started noticing that the central bank, the U.S. Federal Reserve in particular, was starting to distort the very important price discovery mechanism of markets. And so the idea is if companies are putting capital to productive use, then that capital growing drives stock prices higher. So the Fed decided they couldn't wait for all that, that productive process, which takes time. Instead, they decided to drive the stocks higher first with zero interest rates and quantitative easing and hope that the higher interest rates would drag the economy up with them. It doesn't work that way, and it makes the economy worse off. So they first started trying to create this wealth effect, as they call it, by driving housing prices higher in the early 2000s. Now, this was such reckless policy and completely unfair to the next generation. So they took interest rates down to 1% and kept them there, despite the fact that the economy was still growing. Like these were historically low interest rates in an economy that was growing. It was ridiculous. But the reason they did it was to drive housing prices higher. Then people feel wealthier, extract more equity from their home and spend it. And that drives the GDP number. As I say, so why did I see it this way? My job was all about allocating capital and seeing, like, whatever wealth you have is supposed to be a reflection of the wealth that you have created and fairly exchanged with someone else out there. So the wealth you have matches the same amount of wealth somewhere out there cumulatively that other people have because of your efforts. It didn't come at somebody else's expense. Our house here, we're in a suburb of Toronto. We bought it in 2001. It's worth 4 times what we paid for it. So if we sold it, we'd get 4 times what we paid for it. What was our contribution to society to justify making 4 times on our home? There's nothing. We did not create 4 times the amount of capital that our house was worth. we just make 4 times because we bought it just when the US Federal Reserve started this housing wealth effect fallacious economic doctrine. So I was witnessing this going on in the mid 2000s. And then all kinds of policymakers or financial institutions turning a blind eye to these ninja loans, no interest or no income, no job, no assets, giving anybody a mortgage if they could fog a mirror, because it was serving the goals of the policymakers in driving housing prices higher. It was completely reckless and irresponsible, in my opinion, and it ended up being a disaster. Of course, a lot of people lost their homes, and at one point, 25% of mortgages, I believe, were underwater, negative equities, i.e., their house was worth less than their mortgage. This is a terrible position for people to be in, stressful, and so they blew up the whole system. And then rather than say to themselves, well, maybe we shouldn't have done that, they doubled and tripled down with trillions of dollars of quantitative easing, driving asset prices higher. So what they've done is they sacrificed the real economy on the altar of higher and higher asset prices, which benefits a much smaller percentage of the population than the main economy. So that's a long-winded way of saying how I first sort of came upon it.
No, that was good. Thank you for extending into that, because I think it's important. But also being working in finance and being an advisor at this time, if you see that's what's happening, like what would financial advisors and investment managers do? If you see the flaw in the system, it's almost in a way, maybe not your fiduciary duty to say like, yeah, you should buy these assets because that's the way the system is right now. It's almost like in, let's say, like a sport, if I mean, God, I hate to do this, but yeah, if like finance and money management, it was a sport and you see there's a hole in the defense, like, or a weak cornerback or whatever, it's like, yeah, you're going to keep going there because that's where that's where the money is, you
Yeah.
know?
Yeah.
So maybe not a moral obligation there, but sometimes in a fiduciary
Yeah,
manner.
yeah, definitely. And, it was hard to translate that into specific investment decision making because you still have to participate, but it just makes you that much more nervous because you know that so much of what, well, not so much, but a lot of what is going on is really just sort of fake, it's not driven by fundamentals. But fundamentals cannot matter for a long time. There's an old saying in stock markets that stock markets can remain irrational longer than you can remain solvent. And i.e., if you try to time things, if things look, really bad or really expensive, there's too much debt, blah, 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 you think, well, this isn't going to end well. It can go on for a long time before it doesn't end well. And it won't end well. Nobody has a clue with respect to the timing. There's lots of opinions out there, but that's all they are. They're opinions. So I just like to inform people with respect to the lay of the land, give people a straight bill of goods. And then, some people in my company, they used to joke with me. They said, Paul, you're kind of scaring people out there, I said, listen, they're grown-ups. They deserve to know the truth, again, from my perspective. But empowering people with as much information as possible about what's going on in the world, how we manage money, what our strengths and weaknesses are, then you put your client in a position to make the best informed decision with their client's hard-earned capital, rather than, don't worry about it, they don't need to know this, no, people are smarter than you think, and they deserve to know. And yeah, so that was my approach.
So where do you start when you're advising and you're introducing yourself to somebody and a client or a partner or somebody that you're working with? What is the main crux of, because it sounds like it's a do well and do good, right? And be aware, make an informed decision.
Yeah.
What's generally like your starting line and when you bring on a client or you're working with a partner?
Yeah, so my clients were financial advisors, and the starting point with a financial advisor is just being brutally honest with them about who you are. And I believe, might not be true, but I believe that to be successful longer term in investing, It's really important that your investment style is a true reflection of who you are as a person, of your personality, because there are many different ways to invest. My way is, or my team's way, is not necessarily appropriate for everybody else. I'm a bit of a worrywart. I'm a lot of a worrywart, actually. I like to build a solid foundation and make sure everything's rock solid. And then, okay, I'll take a step on it. Okay, that worked out. Let's put some more, bricks in there. And rather than just sort of running full speed ahead and hoping everything's going to be fine. And when you do that, you can give up some of the upside. But the benefit is when this happens, you don't fall nearly as much. And then you put the two together and you can end up further ahead with a smoother ride. But when you're not keeping pace, when Mark is doing this and you're only doing this, people start to get a little concerned. How come, we're not going up as fast as Microsoft and Meta and all this kind of stuff? Well, listen, those are great companies. Valuations are looking a little stretched. I'm not saying they are today, but this is, would be sort of the pitch. And so, the great businesses, when they're cheaper, we'll hold them. When they're not, we won't. And so don't worry about what everybody else is doing. I had this analogy about driving a car across Canada. And the analogy is getting your clients from Toronto, which is in the east, to Vancouver in the west, or let's say New York, getting your clients to San Diego. And if you're successful getting your clients to San Diego and you can drive them across the country, you get there in one piece, then mission accomplished. They'll be able to retire in comfort. And so you're driving along, you're leaving New York and it's starting to snow, so we slow down a bit. The analogy is like stocks are getting expensive, so we get more defensive, so we're not keeping pace. And despite the fact that it's still snowing, these other cars are on the highway and they're passing us in the outside lane. Going full speed ahead despite the dangerous conditions. And then your clients say, well, what's going on? How come these cars are passing us? I said, well, it's snowing outside. Stocks are expensive. And, well, how come they're not concerned? Well, how the hell should I know? We told you that we would get you to San Diego by this time and in one piece. And if we're successful in doing that, you're going to be able to retire in comfort. And we're still getting closer. Every day we're getting closer and closer and closer. And then the analogy went on. And some people like it and they get it. And then some people don't. So as soon as you stop the car to get some gas, they get out and they get in one of those faster cars. And then you might see them in the ditch, a few miles up. But the thing is, a lot of portfolio managers, good people, but often the bonus it can be based on 1 year performance number rather than 10 years. And so if they end up crashing in a ditch, they just get out of the car and get into another car and try and win the next 1 year race. But you've got clients in ditches all across the country, So, it's just trying to keep things clear of what the goals really are and what it is you're trying to do. And if you clearly communicate that, manage very carefully your client's expectations, then you have a much better chance of a good client outcome at the end of the day.
I love that, and you put it in such an eloquent way because that's any client journey, really. Like if you're
Sure.
working with anybody, or even not even a client, like your friends, family, your community, like those are life principles. Yeah,
Yeah.
I love it. You put it in such a nice manner.
Well, thank you. Well, and it's a huge responsibility. Like you get it wrong, you can have a significant negative impact on someone's future well-being. And, that's not going to feel very good.
So in your path, I don't want definitely don't say any names or anything like that. But were there ever moments where you saw in your experience and everything that you were doing that you're like, man, I missed that opportunity, or something that you were like, oh, this is a challenge and not a regret, not, but like if I would have done this differently, I would have had a different outcome in something. Is there anything that comes to mind?
I mean, there were tons of things. Specifically, I don't know if I could point to one specific thing, but there were loads of things along the way. And rather than regrets, I call them learnings, right? You don't really learn from your successes. It's your mistakes that you learn or you should learn from. And so our investment style The name of the funds were called Ivy at Mackenzie Investments. The investment style never changed, but the process, the application of that style necessarily had to change as the world was changing, or as we find a hole in our process. Okay, that ended up being a mistake. Thankfully, it wasn't a big one. So let's plug that up and ensure that mistake doesn't happen again. But yeah, if you're a professional investor, I mean, you should find that investing very quickly becomes a very humbling experience because
Mm.
you're not nearly as smart as you think you are when you're younger. Like you're coming into this and you got a plan and you got a model and we'll do this. It's going, and all of a sudden it doesn't work. And then you start listening to the older guys, okay, now I know what they were talking about. But yeah, just keeping it real. Don't be arrogant. I think arrogance kills a lot of investors and their clients, not willing to admit that they were wrong. And if you don't admit you were wrong about something, then you've just lost an opportunity to learn. Yeah, so some small pivots along the way, but nothing major.
Sure, sure, that makes sense. And you know what? On the topic of arrogance, one of the things that I seem to talk about fairly frequently, and I think it's a big part of my life. When I look at what leadership looks like, and there's a lot of different qualities of a leader, but there's a balance in confidence and humility, right? Where someone's confident and they can be bold, but also like humble, and no, they don't have all the answers, but they know that they're confident enough and have the people around them to get to the destination that they're seeking.
No,
Hopefully,
absolutely.
but
Well,
yeah,
yeah.
it's such a cool thing. So that's what reminded me of that when you mentioned that about the arrogance.
No, thank you. And great leadership is about leading by example. It's do as I do, not do as I say. And entrepreneurs who built successful companies, well, they typically started on their own and built that company up and did every job in that business. And they love providing a great customer value proposition. They just get such a thrill out of it no matter what it is. And because they built the company from the ground up and then they start adding people to help them, they know what a lot of those employees are the challenges that they're facing because the entrepreneur who started it went through it themselves, right? And rather than, an executive coming out of university or an MBA who never started their own business, not all of them, there are a lot of great MBAs, don't get me wrong. But, try to manage the business by the numbers rather than just laser focused on the customer and your staff, your employees. It's really an amazing thing when you see it really humming and everybody benefiting. And it's not just the the customer and the employees, but it's the owners, senior execs, suppliers, and community at large. You need all six constituents of that business model to be benefiting for that business model to thrive longer term. And it makes so much sense. It makes so much business sense, and it also feels really good.
Yeah. Well, one of the things that just reminded me of, especially when you talk about people that come out of university and they're, at their MBA, and they understand, they know the mechanics, the numbers, they know those things, but there's a difference between somebody who knows the theory and somebody who's actually been through the mud, right? And so
Yeah.
I look at it sometimes, it's like you can know everything about hydrodynamics and the history of the oceans and all this stuff, but until you get in the water, until you
Yeah.
get hit by a couple of waves, like you got to get wet.
Yeah.
You got before you really truly understand.
That's
There's
a
a
great
difference.
analogy. Great analogy. It's so true. Yeah, I had plenty of examples of companies that were like that over the years. Plenty, and I have a chapter in my book called Corporate Culture, and it discusses the good corporate culture companies and bad corporate culture companies, with a couple of examples of each.
So I am going to include your blog and your book linked to that in the show notes here as well. So I
Great.
will be sharing that and your website. And so
Oh,
but without spoiling the book, can you dive into one of those things? Like let's start with corporate culture. Can you give us some cliff notes on your thoughts?
sure. Yeah. So again, like I said earlier, great corporate culture, but it does. It starts at the top, you know, and that's a real trickle down effect, where the you lead by example And that attracts similar minded people. And those who are not like that end up leaving. They sort of self select or they get fired. So making sure all the constituents benefit. But most important is that you've got to have a real customer value proposition that people value and they want to exchange their hard-earned capital for whatever it is you have to offer, a product or a service. And you have to constantly reinvest in your business to make it better, make it more competitive. And the one example I use in my book, well, there's a couple, but one example is of a good corporate culture. It's a company called Fastenal. They're based in Minnesota, and pretty basic business. They distribute fasteners and screws and stuff. So we had a tour of their plant. This is 15 years ago or so. Plant manager is so excited about these screws, and he's going on. Oh, our customers love us. Check these out. Blah, blah. What the hell's going on here? Is this part of the Apollo mission? No, it's just screws and stuff. And so I asked him. I love asking very simple questions. And as an investor, you learn as well to not ask leading questions. So I just said, "So, why do you love the company so much?" I said, "What do you mean?" I said, "You're so excited. Why do you love it?" And he started, "Well, it's management, ownership. They respect us. They listen to what we have to say. They implement a lot of our ideas. It's not just lip service. We're like a big family here. It's real. And we all participate in the success of the business." And then he said, "Oh, yeah, I forgot to tell you." So the founder was the CEO. He owned a third of the company. A few years prior, his wife had passed away, and she owned a good stake in the company. So the CEO took all of her shares and he redistributed them to all the employees in the company. That is great corporate culture, right? And he's not doing, I never met the guy, but I'm sure he didn't do it thinking, well, I'll just do this and I can get these jerks to work more overtime. No, he loves his employees, right? He founded the business. He knows what they're all going through. That's what it's all about. Versus another company that is not run by a founder. It might be, I call them career executives. There are a lot of fantastic career executives. So again, don't get me wrong, a lot of impressive people I've met over the years. But there are a lot of not impressive career executives who could give damn about the customer value proposition. So rather than consistently give more value to the customer, they try to extract value from the customer. So they might keep the product the same and raise the price. So, well, you've just been screwed, right? You're getting less product for more, or the same product for a higher price. Or they extract value from the product itself, but charge the same price. Either way, you're getting screwed. And so often what these poor corporate culture CEOs will do when they come into a business is not about, the first thing isn't about, okay, what can we do for our customers to make sure that they're excited about what it is we're doing? How can we make their lives better? No, the first thing they do when they come in, okay, how many employees can we lay off to improve our profit margin? How much debt can we take on to buy back shares and drive our share price higher without resulting in financing costs that are too high? This is the sort of mindset. And that mindset for years has been rewarded by Wall Street. So if a CEO would come in and say, I'm going to fire 5,000 people, I'm going to take on $10 billion to buy back shares this year, the share price goes to the moon. Everybody's happy, except for the employees that are being laid off. And you might even pull back on investment in your business. The product won't suffer today, but it suffers in 5 years' time. And then it's too late to do anything about it. But by that time, the career executive has left and gone on to another challenge, And again, they're not evil or mean people. I think it's just people are influenced by the reward system. So I think it was Charlie Munger who said, he was Warren Buffett's right-hand man. He said something like, you show me the incentive and I'll tell you the behavior.
How rare is it to find a company that was the former rather than the latter? When you're evaluating businesses, is it that rare to find these good company cultures? If you were to give it a percentage split.
Yeah, no, it's not they're not rare. Unfortunately, the bad corporate culture ones are not rare either, you know? And I couldn't even put a percentage on it, but there are plenty of them out there.
But is it really easy for you to see from your experience to see
Sometimes,
what a company culture is and like, oh yeah, these guys got it, or like they're teetering, they could
yeah,
go either
yeah.
way.
Yeah, sometimes it's obvious. Like the first couple of sentences of a CEO letter, sometimes you could, oh, okay, this is going to be good, or it's going to be bad. Sometimes the numbers themselves will tell you about corporate culture. So we used to build all our models from the ground up and go a number of years back, go back through until we went through a recession. So when companies go through a recession, or their response to that recession tells you a lot about the business. And so year by year, plugging in the numbers, you could see if there are write-offs or acquisitions or if there was an accounting change. There's lots of latitude in accrual accounting and stuff. And, are they trying to hide something, or do they keep changing their mind every year? Or do they say, know, I remember one, they had this like really wide target of profit. So let's say it was, you know, 500 million to 1.2 billion or something. I can't remember exactly. And they just got it to like 502 million, and, the commentary is, yes, glad that we achieved our profit targets and stuff like that, but then they also keep moving things around and yeah, so just looking at the numbers can tell you a lot about the personality of the business and whether or not you want to stay away from that. And it doesn't mean that those share prices won't do well. They might do well for all the wrong reasons, but you just don't want to be a part of it because, if they're doing well for all the wrong reasons, you can't predict when it's going to fall apart. And really solid companies that are doing all the right things, sometimes their share price doesn't respond either. But as long as you keep doing the right thing, you maintain a strong balance sheet, you keep winning your customers, that you keep producing more and more capital over time, that's just going to, this relentless force pushing up the share price of great corporate culture and doing good things. And that's your foundation, right? That's real. That's something you can almost touch it, but the other stuff, it could be disappear overnight, right?
Again, I draw the parallels in, let's call it social capital, and doing the right thing and eating healthy and exercise and
Yeah.
reading and meditate and all those things, you just keep doing the right thing well enough and over time. It's amazing how some of these principles are universal.
No, absolutely. And there's no guarantee, either. What it does, it puts the odds in your favor. And you want to be doing that as much as you can.
It sounds like from especially the business valuation portion of your career and, working with financial advice and doing these things, you can learn a lot from your clients and the people that you're working with. Would you say there's specific lessons that you've learned? I mean, there's this meta, holistic view, but there are specific examples of instances where you're like, I learned a lot from this business and this is why. Is there anything that stands out?
Yeah. In terms of the businesses we analyzed, I mean, there was tons I learned. I mean, specifically, there was no like sort of eureka aha moment. Oh, it's changing my life, but as, oh yeah, I never thought of that. That's good.
Mhm.
Um, and with my clients, I learned with my clients by having discussions with them over the years, to your point. And I remember when I was starting off in my career, so this would be early 2000s, my goal back then was not so much to educate people, it was to win the business. And so my main goal was to impress them, trying to impress them with respect to how smart I was and how much I knew about the business. And so if I impressed them, they might not know about exactly what our investment style is, but if they think I'm smart enough, they'll give me their money. And then, that was working okay for a couple of years. But then I started getting caught in like little white lies. And no, I wasn't really lying. It was more that, when I was talking with a client, I might have left something out that I knew they would have wanted to know, but it might not have led to a sale for us. And then when I saw them the next year, I'd be talking, and the client would say, "Well, Paul, you seem to be saying something different than you said last year." And I can't remember what I said last year because I probably wasn't telling the truth. And there's a great line, I think I put it in my book. I forget who said it, but they said, when you tell the truth, you never have to worry about what you said, right? No, I just told the truth. So I got nothing to hide, nothing to worry about. And it was really embarrassing being caught up in these contradictions. And so, yeah, at some point I just said, you know what? I'm not doing that anymore. Like, here it comes. Here comes the truth, all the gory details, whether you like it or not. And as I said earlier, put your clients, your mature clients, smart clients, in a position to make the most informed decision that they can with their clients' capital. Now, that was a
Yeah,
big
that's
learning for me.
yeah, no, that's great, and especially like when you tell the truth, you don't have to worry about covering up anything because it is it's just the truth. And
Exactly.
especially one of the things that I think also when you have a confidence, and it's not hard to sound like you mean what you say if you just say what you mean. And there's a nice way to do it,
Yeah.
that you
Oh,
figure
yeah.
out
No,
that
yeah.
way.
Yeah, no,
But
it's
it's like, yeah, just say that you don't have to really apologize. And if you do, like, you can explain it because it is what you really meant and it's the truth to you, at
exactly.
least.
Exactly.
Was there anybody that you looked up to as a mentor? Because again, we've talked about like the different lessons you learned with your peers and your clients, but are there anybody that you look up to? You mentioned Charlie Munger and Warren Buffett. Is there anybody that you read that read their books or listen to their work?
Yeah. Yeah, definitely in the early years, Warren Buffett and Charlie Munger, particularly their shareholder letters before the great financial crisis. I think that's great reading for any uh, person who wants to become a professional investor or even just doing your own book sort of thing.
Or
Then,
mentor in your career, somebody that
yeah,
showed
yeah.
you the way.
So, yeah, so my old boss, Jerry Javasky, was, fantastic, very smart, very humble. And he really taught me about valuation, how to value a business, which I was lacking in. And he taught me to be a bit more skeptical about what was going on in the world, because when you're younger, you read an annual report from a company, it sounds fantastic, it's very easy to fall for it all. And so he was great. And then there are, a few economists. My readings over the last 15, 17 years or so has all been economic philosophy and history. So there are a couple, Bob Murphy, he's of the Austrian School of Economics, and George Selgin, who's a free market or free banking type economist, and Stephen Roach, he used to work at Morgan Stanley, and Stephen Cates, he's Canadian but lives in Australia, and he writes from a classical school of economics perspective. And economics is a social science. It's like a soft science, like psychology, a natural science like chemistry or physics, where you can put like formulas and you can isolate different variables and stuff like that. You can't do that in economics. So there are a number of different schools of thought with respect to how an economy really works. And the problem with that is it makes it very easy for politicians to choose the school of thought that most closely aligns with their ideology, i.e., take on debt and spend like crazy. And so there's always somebody out there who will give you the intellectual justification or the complicated formulas or the graphs that make it look like this is a good idea. It's not. It's a terrible idea. But, it's very easy for politicians to fall for this.
Yeah, that's a good way of putting it. That it's more of a soft science. I want to make sure that we take some time here because I know we briefly touched about your book and your blog. One thing that I'm really interested in, because you started the book 6 years ago, did you say? Okay, through a creative work that encompasses your life and your lessons and the things that are going. What have not just with the book, but I say with the blog also. I would love to hear like what you learned about yourself and what was revealed in your knowledge and your experience through creating and working on and growing the blog and then writing the book. Like what did you learn about yourself?
Yeah, so I would say I would say that, not to be quite so sure of yourself. Now, I've always tried to remind myself of that, there may be another way of looking at this. Can I look at this from somebody else's perspective? Um, and so in doing that, writing the book, first of all, because, when you just have the thoughts in your head, it feels good when you're thinking about how smart you are in your head because you've got all the answers because nobody can challenge you inside your head. And you often don't challenge yourself. You just think, well, this is the reason this is like that, blah, blah, blah. Okay, great. But when you put it down on paper, all of a sudden, all the things you were so sure about are now in a place for the whole world to see and possibly challenge you. And so I find that I learn just by writing. As soon as I start to write, I start to see things differently, think about things differently. Very important to get it out of your head and on paper or in audio format like this. And then in doing these podcasts, with different people who see things differently, has been also a good learning opportunity for me. It's very easy to just convince yourself that this is the way it is, and these people need to smarten up and blah blah blah. But no, you're not in their shoes, and I think it's really important to put yourself in a position of other people, and you'll have a lot more sympathy or empathy for why they do certain things. And most people, I believe, are not only very smart, but most people are good people and want to do the right thing. The problem is with our system, our monetary system. It's rather than the mutual benefit of both creating capital and exchanging it, we have more and more people now making capital or getting capital at the expense of somebody else. And so, in particular, the next generation, younger people can see that despite the fact that they're better educated than their parents, work just as hard, can't hope of having the same sort of lifestyle as their parents had, particularly when it comes to housing in countries like Canada and Australia. And now it's getting worse in the US as well. And so they know that it seems to be unfair. They know that wealth disparity has grown, but it's hard for them to connect the dots between monetary policy and all that. And so then it becomes very simple or easy for Democrats to blame Republicans and Republicans to blame Democrats. And, good people on both sides just getting increasingly angrier with each other and increasingly divided. It's so sad what's going on, in my
Mhm.
opinion. And bad systems, be it in a corporate environment or an economic environment, brings out the worst in good people. And, we've all been there, been in bad situations that bring out some of my not finer moments. And the opposite is true. You have a good environment, good corporate culture brings out the best in people. And so my book explains in easy to understand terms, step by step, what's been going on and why. And I truly believe that with a greater understanding, through my blog and my book and all kinds of other people who are doing great things, that once you understand things, your anger tends to go away, or it's not quite as angry, like, okay, I get it now. And then start demanding better actions from our policymakers with that better understanding. And then our policymakers will do the right thing, but they're only going to do the right thing if we demand it of them. And for the last 30 years or so, we've been demanding something else. And so they've accommodated us. But if we demand the right things, they'll do that too, because that's what they have to do to stay in power. And they want to do the right thing. They do. But doing the right thing today is like political suicide.
So I mean, big question. I'm going to throw it all out there. So, and maybe you answer it. So, what's the answer? Is it understanding or trying to understand? Again, I'm not expecting you to have the answer, but maybe you do. Maybe it is, and everyone does their own part in writing and blogging and just sharing information and being a good person in the world. But do you have a thing that you're like, this is the answer?
At the end of the book, I have my sort of 10 things that need to happen. I mean, there could be more, maybe it's less, but that would help set us on the right path. And one of them is that we need to stop believing in this something for nothing fairy tale myth where you can have your cake and eat it too, which politicians have convinced people is true. It's not. But so if the population believes that we can have something for nothing, then they're going to get angry at the government if they don't spend all kinds of money and give them this and do this. And no, like in economics, Thomas Sowell is an economist. He said, in economics, there are no solutions. There are only trade-offs. And so if you do this, then you can't do that. Or you do that, then you can't do this. And so we have to make an honest assessment of those two choices and which one are we okay with? Are we okay with not having this or not having that in order to get this? And people are smart enough to figure it out if you help them. And so I really do believe that it really is just about understanding what's going on. And there's just way too much fallacious economic doctrine. Like my generation, I'm 63. I've made 4 times on my home. Most people that I talk about this with, as soon as I tell them, they understand. They understand that I didn't deserve to make 4 times on my home because my home is not a productive asset, right? But my home is not producing 4 times as much stuff as it did when I bought it in 2001. It hasn't grown 4 times in size, hasn't relocated. No, we make 4 times because central banks drove interest rates to zero, printed money, housing prices soared. And so now a younger person or a newcomer to our country, they have to pay 4 times what we paid for the same economic good. It's a transfer of wealth. It's a redistribution of wealth from the next generation to my generation. Now, I haven't broken any rules or laws. I played the game like everybody else. But I made money on my home, not because I'm a great real estate investor and I timed it well. No, I just needed a place to live. And most of my generation get it when I tell them that. But every now and then I run into someone who doesn't like it because they still want to feel that they warrant making 4 times on their home. And it's just a very simple concept. If you did not contribute capital to society and you take capital, then it comes at somebody else's expense, full stop. But sometimes it's hard to connect the dots. And it's all about capital. It's not about money. And money is very important. But again, the understanding. So the difference between capital and money is, let's say you make bikes. You're creating capital. And let's say I make suits. You make a bike, I make a suit. We exchange that capital that we both produce. Now I've got a bike and you got a suit. Now, before we started, there was neither. We made a bike, we made a suit. Society is that much wealthier, one bike and one suit. And importantly, it didn't come at the expense of anybody else. Now, let's say you make 10 bikes. We don't have direct exchange barter, right? We exchange things with money. Money is a medium of exchange. So you sell your 10 bikes, your capital, for $10,000. You put your $10,000 in the bank. What that $10,000 represents is the 10 bikes of capital that you produced. You're temporarily storing up 10 bikes in your $10,000. That's what gave that money value. Now, before you spend it, let's say the central bank doubles the money supply. When the central bank increases the money supply, they just print it out of thin air. They didn't create any capital to get that money. Just create money out of thin air. So that money has no capital stored up in it until it comes into circulation. And then it extracts capital from the rest of the money already in circulation. So it takes 5 of the bikes from your $10,000 and puts it into the newly printed money. So in your bank statement, it still says that you've got $10,000 in your bank account. You think that's great. Well, no, because now instead of storing 10 bikes, it only stores 5, So your money is only half as valuable as it was when you first sold your bikes. And now, so your $10,000 will only buy half as much as it would have done before the central bank doubled the money supply. And that's why my book is called Capital Offense: Why Some
Wow.
Benefit at Your Expense. But it's just, and I have all kinds of analogies and stories through the book, to keep it easy to understand, not intimidating. But with understanding like this, all these things, then I think people will realize that you cannot get something for nothing. Printing money is not the answer. Artificially driving asset prices higher is not the answer. It makes us poorer as a nation rather than richer. And then they'll demand a stop to it. I don't know any other way of doing it. What could trigger the desire for better understanding and action, unfortunately, is a crisis. Because it's in
Yeah.
times of crisis that people finally, after they have a heart attack, they start eating better. Hopefully they survive.
You would like to be able to learn from other people's mistakes or seeing other things and be like, okay, I don't want to go down that path, or seeing somebody the way they're living their life or what they're doing and learn that way. But you're right, most times people learn from their own. And I'm excited to read your book.
Well, thank you.
I'm really excited. I have a feeling I'm going to really enjoy it. And I'll tell you what, you mentioned the trading for the pants for the bike. You better be a heck of a tailor because I make a mean bike. If you're going to be trading me those pants. But hey, listen, Paul, this was absolutely fantastic, and I would love to have you on again, and we can go
Love
into
to.
more. But you've been so gracious with your time. Before we close out here, just one more time, where people can find you. Give us the website. Give us the blog.
Yeah. Yeah. Thanks, Dustin, for having me on. I really enjoyed it. And happy to come back anytime you want. There's lots to talk about.
Yeah, there sure is.
Yeah, yeah. So yeah, my website is Paddington Capital MGMT.com. So MGMT is short for management. And then there I've got it's a free blog. You can sign up. And I've got all my past blogs. You can go back and read all my ranting and raving. And there's lots of fun stuff in there too, like history of a company or stuff like that. So I think people will enjoy it. I've got a summary of my book there as well, Capital Offense: Why Some Benefit at Your Expense. And it's available on Amazon, Barnes and Noble. Thrift Books has it as well. And then, yeah, all my social media stuff tends to be Paddington Cap. So Paddington CAP. So I'm on LinkedIn and all the usual stuff.
All right, fantastic. Well, again, I'll include all the links in the show notes.
Awesome.
Paul, it's been wonderful. Thank you again.
Thanks so much, Dustin. Take care.